And we definitely reserve the best for last. And it is really my true honor to welcome Gobernador Escrivá. Thank you so much for joining us today.
A pleasure.
We've been having lots of interesting and relevant discussions today around many, many topics. But I think one common theme has been uncertainty. And uncertainty because of significant changes in geopolitics, trade policy, regulatory policy, et cetera. The US, obviously, but many ingredients. Share with us your sense of the economy from a global perspective. Where is it going in this context of such a level of uncertainty?
Well, the world economy is subjected to a very sizable negative supply shock. If I want to summarize what we are confronted with, is basically a very sizable negative supply shock. The uncertainty, which is also very high, remains, I would say, in terms of how it's going to impact various countries, how persistent it's going to see, some of the channels in which they are going to impact sectors or economies and markets, but certainly the shock is very big and negative. So in that respect, for the global economy, you will witness over time a downward revision of growth projections to different degrees, no doubt, and probably, certainly in some jurisdictions, upward revision of inflation projections. Seems to me that this is what is more tangible at present. I would say that while this is a shock, and shock normally has a related word, which is unexpected. Was it so unexpected? Because some of the policies that are implemented were already anticipated, even written down in papers by key figures of the new US administration. So what is probably surprising is why the market didn't anticipate that we were under negative supply shock, particularly to the US economy, to the global economy, but in particular to the US economy. I'm just remembering now that just 2 months ago, I was in Davos, in the World Economic Forum, in internal debates, but also in some panels, and the markets were extremely bullish to the US economy. Actually, in the months prior to the inauguration of the US administration, that happened basically when we were in Davos, there was a 5% increase in the stock market in the US, 5% appreciation of the dollar, etc. So the market were basically, surprisingly enough. And I'm saying that because I said the opposite there. I said, but I remember in one debate that I said, but really, do you really, with asset managers and market people, I told them, do you really believe seriously that these policies are growth enhancing to the US? Because
maybe they didn't believe they were going to take place. Maybe they didn't.
They basically took that deregulation and lower taxes were going to be increased revenues, profits, and yes, look at this narrowly and in a short-sighted way to that point. But there was a full package. Huh? They were very selective in taking some elements of the package, but the package was full and anticipated. So maybe it's not so. We are very much surprised, but it was there. It was just really.
But you can still see the market trying to understand or predict what's going to happen.
It's adjusting.
It's been correcting.
It's adjusting. There is a further, because it's primarily negative supply, but at the same time, at least in Europe, and maybe also partly in the US, there is a demand shock stemming from more expansionary fiscal policy. In the US, I would say probably yes, because the reduction in taxes will outweigh any potential expenditure cuts that are less tangible. And in Europe, because of one of the dimensions of the supply shock. Negative supply shock is a threat to European security, no doubt. And as a result of that, there has been a very rapid response in terms of, let's say, a comprehensive package of enhancing security in Europe. And this entails a significant increase in military expenditure. In addition, Germany has decided, which is important, to increase significantly fiscal expenditure, investment in particular, on a number of sectors.
Yeah, so it sounds like there might be a moment for opportunity actually here in Europe. If we stop looking at the global and focus more on sort of the outlook for Europe itself.
I would say so, and I think this is the sense here in Europe. I mean, I think that we are very much, what I see is I let you something. I mean, the European project, or the European, has been underestimated by Americans on many occasions. How many times I have seen people from the US taking for granted the end of the monetary union, or betting against the monetary union, and they failed consistently over time. So let's not forget that. I mean, and it's true that prior to the pandemic, with Brexit, etc., the European project was, let's say, less attractive. But with the pandemic and with the war of Ukraine, Europeans were subjected to a shock that they perceived that should unite them, because it was something that, like a threat to entire Europe. I mean, the COVID was one, Russia was one, and now there is a new one.
We might be in another one.
Certainly there is an economic threat.
Urgency for unity in Europe.
And the response has been similar to that of the COVID. I mean, in terms of sense of awareness and mobilizing, I would say, resources, and also having the perception that this situation is exceptional and needs a response. So if you create uncertainty, and this is, and let's say, there is a loss of confidence in the US policies and willingness to collaborate with the rest of the world. And I think that Europe can really fill partly this gap and has the potential to do so if it moves in certain directions, yes.
So let's talk about Spain, and in that context. If we look at growth rates, they're significantly higher than the average in Europe. So are we seeing something that is truly structural, permanent? How do you look at the trajectory for the Spanish economy?
I think it's a combination. I mean, we have still to disentangle how structural or conjunctural is. But certainly this time around, I mean, there are elements that looks more permanent, or at least persistent over time. I think that the configuration of the world and Europe after the pandemic is favorable to Spain in different directions. One is there has been an increase in the preference for leisure of European citizens, and Spain is a provider of
a good one,
relative ones of more than others of that kind of services. And this looks structural, or at least persistent, and we are benefited from that. After the pandemic, Spain has managed to reduce energy prices, in particular electric prices, significantly. Now prior to the pandemic or the Ukraine war, I mean, more related to that, it was around electricity to industrial consumer was more or less on the European average. Now it's 30% below and remains, and if you look future prices, looks to be persistent. So that stems also from the bet for green energies, and also the capacity we have to produce them in cheap than others.
Right.
So this is another positive shock. Third shock, I would say now after the pandemic, more services are provided remotely, teleworking, and Spain offers possibilities not only because of the weather or conditions of living for people working remotely or digital nomads. We are really attracting quite a number of skilled workers for that purpose. but also because we are very good and we invested significantly on digital networks. And I would say we have very good infrastructures, and which are important for that. So all of a sudden, investments that in the past were not so clearly efficient are now becoming more relevant. For instance, Spain invested a lot in infrastructures, public infrastructure, railways, airports, look even excessive. But now with this demand, I mean, you make a better use of this stock of capital. The same with energy, green energy, or the same with digital networks. I mean, these kind of things are now more useful. Or hotels now with this is less seasonal, the provision of tourist services. All these things make the economy more efficient or more intensive use of the fiscal. Then migration policies have been more, let's say, inclined to accept particularly skilled workers, but in general workers. And so we don't have the kind of, I think we don't have the kind of shortages in the labor market, or at least less than other countries in the world because of these policies and the kind of migration patterns we have. And maybe finally, geopolitically, I don't know, maybe to be located very much in the West and very much in the south of Europe helps.
Yeah. So how do we translate all that to a recipe for Europe? So the common theme through this conference has been growth and competitiveness. What's missing? What does Europe need to really achieve that?
Well, Europe, I mean, Spain should not be a model in many respects. I mean, don't take this as over. No, I mean, but maybe it's a model not only Spain, but Portugal, Greece, to some respect, that countries that, at the national level, made a number of things after the crisis, have made their economies more flexible, for instance. And they are taking advantage. The Southern Europe or the periphery of Europe, that after the financial crisis had to make decisions and to adjust, now might be reaping benefits from that decision. So that implies that, although when we need more Europe, more European-wide policies and initiatives, it's also true that at the national level, by taking higher standards, we can also contribute to the entire growth of Europe by being more productive, I would say. But for Europe, I mean, seems to me that we need simplification of regulation, which is dense and heavy and complex. In part, this has to do with the fact that we produce legislation, which is here at the European level.
Yeah.
I mean, I have some experience in producing norms here in Europe for previous jobs I had, and basically, I mean, consensus building implies deterioration of the quality, also in the consensus at the Council level, but also with the European Parliament. So at the end of the day, you get something which might be of better quality in other conditions. So that's something that now, so all the initiatives from the Commission in terms of simplification. These omnibus packages, some of them look really substantive, and I think that goes clearly in the right direction, so this need to be valued. I mean, the capital market, the so-called saving and investment market initiative, looks important. I think that, in a way, we need more risk-taking in Europe. I mean, Europe, this is a society which values cohesion, values certainty, and we have to basically weigh this against the need to also reward risk-taking, reward the fact that success needs to be rewarded, and that's something that is more a cultural problem, but it's a matter of incentives in Europe. So there are quite a number of things that could be done in order to be more attractive in Europe in this respect, and to keep probably more human capital here in Europe, to keep also, let's say, savings in order to reinvest in Europe with more inclination for innovation. This requires changes at the normative level, less fragmentation of the market, but probably it's a matter of small things from many people.
It sounds like also it's a changing paradigm a little bit.
Precisely.
And someone in a previous panel was mentioning Europe was proud of exporting regulation, and many regulatory initiatives that came out from Europe were copied from the rest of the world. Probably it's time to step back a little bit.
Particularly in terms of simplification. Deregulating as such, I think, is the density of all the norms of different levels that creates, let's say, like a web of complexity.
Let's switch gears and talk about a topic that this audience really cares about, which is the digital euro. And I know that is a topic that you have been thinking about hard. And you've heard the industry's concerns about the digital euro, but I think you have also linked this to the realities also in the US and the direction of travel there. Tell us, what's your conception of the digital euro, and why is that the way forward here in Europe?
I think the concerns of the banking industry in Europe stem from two elements that, to me, are not sufficiently grounded, or at least overweight a number of elements and underweight others. The first one is a fear, I think, that they could lose deposit base because of
intermediation.
To a shift to central bank money in digital form. To me, this is ungrounded. I mean, because we are responsible. We are responsible for financial stability. It will be done. It will be undertaken by the European Euro system, European ECB, and we are going to avoid that. By contrary, I think that it might happen exactly the opposite. And the other one is because of loose revenues for payments and transactions, transactionality. Also not grounded. If you look at the, let's say, at the pie of revenues of payments and transactions in Europe, in the European Union, a significant portion stems from the currency, from the euro banknotes in terms of seigniorage. Another one is basically in hands of the car industry, the card industry, the brands, the big brands. Now, increasingly, you see hyperscalers from the US in the payment intermediation. So at the end of the day, and now it could be also stable coins, also stemming from the United States, trying to be in this business. Seems to me that the European digital euro intends that the bulk of all this remains European, with all the shift to digital forms of payments, that it is done and undertaken by institutions under the supervision of the European central banks, and that is European technology. So it's a win-win to the banking industry, no doubt, if you look from a medium-term perspective and taking into account all these elements. I have no doubt.
Okay, so you see a way forward where those concerns could be addressed and that the digital euro can be...
with holding limits, of course. There are a number of things that can be clarified sooner or later, but from a medium-term perspective, from a European perspective, this is a very important move in the direction of ensuring European autonomy, sovereignty in the payments area, and also keeping European technology.
The financial sector. So we talked about the European economy. Let's talk about the European financial sector. How do you see it going forward? Any risks in the horizons that we should be concerned, and how resilient, stable, and ready for the needs of financing the economy do you think the sector is today?
I think that we have developed in Europe a financial regulatory and supervisory framework which is very solid, And this, together with the collaboration of the banking sector in Europe, has resulted in a banking sector in Europe, industry, which is very solvent, is very well capitalized, of course. I mean, risks are very much contained. I mean, and I don't see significant risk, even sectorally or not, from a geographical perspective. The entire union banking sector is in a very good shape, and I would say even if you try to look at this from different, more sectoral or geographical perspective, the answer is the same. So the reason why probably credit, if it is the question, is not still, is picking up. I mean, it's certainly moving in the right direction. Credit in Europe, now with lower interest rates, it should help. It's more, I mean, if credit has not been strong enough over the last few years, is basically demand-driven. It's primarily demand-driven. It's true that the European economy is not very buoyant. I mean, and in particular, investment, private investment has been rather subdued, and this is reflected. Also, households has been in a conservative mood in terms of consumption, so in a way, in a situation created by the uncertainty of COVID and then higher inflation, war, etc., I don't see a supply problem in terms of credit. That could be an indication that the banking sector is not really performing as it should. It's primarily demand-driven, I would say so.
Some of the ideas being put forward include reactivating certain sectors or products such as securitization, for example. Do you see a role for that going forward?
I mean, I personally think this could help a great deal. I mean, this view may not fully shared in the central bank community, but to me, I would say so. I think it's important that maybe in the future we have a more extensive and hopefully so capital markets in Europe, but for the foreseeable future, the financial system in Europe will remain basically very much bankerized. So we rely on the banking system for financing of many sectors and portions of the economy. So for that, you need to move to a model in which you can rotate the balance sheet more rapidly and transfer risk to agents, funds that are really prepared to take more risk and more specialized in this. So I think it's important that this is happening soon. And on that, I mean, there are a number of things that we could do at the European level in order to foster synthetic securitization is already doing well, but it's limited. But more traditional one could be enhanced by a number of decisions on the regulatory front and supervisory front.
As part of the recipe,
yes.
Yeah. You mentioned savings and investment union. What about the banking union? There is that last component that hasn't been completed. Is there room? Can we be ambitious enough to see a full consolidation of the banking union?
Well, there's a new commissioner now, Albuquerque. She's really pushing for that, and I think that I mean, hopefully this could be a relevant move. Also, if we manage to create maybe more competition at the cross-border level in Europe, because this union is perceived as more favorable to that, would be helpful, yes.
We still have room for that. Gobernador, unfortunately, I have a red light blinking in front of me, and there is a cocktail, everything waiting for everyone.
Excellent.
But thank you so much for coming today.
A pleasure.
I appreciate it. Thank you.